All right, welcome back, everyone. We are episode 8 of the AVID Investor Podcast with me, your host, Josh Adamek. And today we're going to talk about the benefits of buying down your debt, eliminating your debt, and living debt-free. And I'm going to tell you, this is a subject that a lot of people don't talk about. Most people don't talk about. Actually, there are very few people that talk about this method and this way of thinking, and I'll tell you why. It's because the only person that benefits from this is you. The creditors lose out. The financial institutions lose out. The salesmen lose out. That are going to put you in a bigger product, a more expensive product. Many people lose out when you adopt these principles. And again, the only person that benefits from this is you. So it's a subject that many people, very few people talk about. So let's dive into the details. What I mean by buying down your debt and eliminating your debt and living a debt-free lifestyle is you can look at it from both a personal standpoint and a business standpoint. And when I say buying down your debt, I mentioned in a previous episode, I talked about ROI. ROI is very important to me. I look at ROI in most things in life. ROI is return on investment. If I put this out, what's created in return? Not necessarily what do I get in return, but what is the benefit? What is the ROI? Because a lot of times I'll invest, I'll invest time, I'll invest resources. There's a return on investment, but it may not be a direct investment or a direct benefit to me. So, but when I look at the principles of buying down your debt and living debt free, that is something that typically, I benefit from. So, when I look at debt, when I look at financial obligations, when I look at balance sheets and income, and what's going on globally with my personal finances and with my business finances, when it comes to business, what I mean by buying down your debt is when you have some excess income, when you have some excess cash, you can do several things with it. You can take that money, you can reinvest it into something new. You can go out, obviously, you can blow it. You can buy a boat, you can buy a car, you can buy, jewelry, whatever. What I prefer to do is, one of the strategies that I've adopted early on was, can I take that chunk of cash? Can I take that excess income and can I take it and can I buy down some existing debt? And if I do that, what's the return? What's the ROI? What's the return on investment? So, for example, as I mentioned in previous episodes, early on, I bought, I built a rental portfolio with some traditional financing. I would buy a house, and again, I started this business with very little resources. I had no money. There was no hand-me-downs. I didn't take over, mom and dad's business or anything like that. I started, basically from zero. So when I started my business, when I started building my real estate portfolio, my portfolio of rental properties, I would do it the traditional way. I would get some financing, typically some hard money, some financing that was available to buy the home, to rehab the home. And then I would then go to a bank and refinance that. And I would do that over and over again. So when I was building my rental portfolio early on, there was typically debt attached to each of those homes. Now there was a spread, the debt to the ratio was low, I don't know what the ratios were at the time, but, maybe I'd borrow 50, 60, 70% LTV, basically pull out, what was spent on the property, and then, do that again. So when I was building that portfolio, I would have debt attached to those properties. Now that I'm a little bit much further along in my investment career in my portfolio, and we have, might get to the point we have some additional income. There's some cash infusions. Maybe there's some sales, or, some of the, for whatever reason, there's some excess income. Well, I will sometimes take that excess income, look at that excess income and say, what can I do with this? What makes sense? Do I want to buy another property? How can I reinvest this so it makes sense for the long term? And what I will do, for example, and I'm just using round numbers here. I am, I'm doing this math in my head. So, if the percentages are off, if the ratios are slightly off, don't give me a hard time over it. Just understand, try to grasp the concept and the message that I'm trying to get across. So, as I said, for example, let's just say I have $50,000 or $75,000, that's available to, do something with. Now, you could go out and buy a car. You could go out and buy a boat. You could go out and buy something stupid that's not going to get you any further ahead. Or you could take that chunk of cash and look at your existing capital stack, your existing debt, and say, where does this make sense? And what I do under this thinking, under this method, is if I can buy down debt, if I can eliminate debt service, and that equates to more than a 10% ROI, return on investment, I will typically do that. So, for example, let's just use some round numbers. I have a rental property that I bought years ago that, that's a solid property, good house, good neighborhood. And let's just say there's an outstanding mortgage on the property of $60,000. So you have a mortgage payment of $60,000, or a mortgage balance of $60,000. And let's say, just for round numbers, that monthly payment is $500 a month. Now, sure, that current property might be renting for $1,200 or $1,500 a month, or, whatever the case may be. And there's a spread, there's a margin on the cash flow. It's still self-supporting, and it's still, making some money. But if you look at the ratio, at the calculation, there's a $500 a month payment. There's which is $6,000 a year. There's a $60,000 outstanding balance. So the cost of that $60,000 outstanding balance is $6,000 a year. If I take $60,000 and pay off that outstanding balance of $60,000, eliminate that $6,000 per year, that $500 per month payment, that's a 10% ROI. Now, you can use that method, you can use that thinking, create a 10% ROI. You just freed up $6,000 a year. You've just increased your cash flow and increased your net revenue by $6,000 a year. You can use that thinking, those principles, or you could take that $60,000 or whatever that is. You can put it somewhere else, maybe put it towards another property. But for me, I look at creating greater spreads. We talked about in previous episodes, assets versus liabilities. And don't get me wrong. I mean, there is nothing wrong with responsible leverage when it comes to business. There's nothing wrong with having debt, against cash flowing, self-supporting assets. But if your goal is to increase assets and reduce liabilities, buying down your debt makes perfect sense. Now, why I say most people don't talk about this is prime example right there. I've taken that $60,000 and I've paid down some debt. That debt was already accounted for. The bank has already created that mortgage, created that loan. They've already been paid on that. By me paying down that loan, the bank loses out. They're losing interest rates. By me taking that $60,000 and paying off that loan, rather than going out and buying something new, whether it be, a boat, a car, or jewelry, or whatever, all those people lost out on that sale. By not taking that and reinvesting by not taking that $60,000 and buying another property, there's a loss on a loss of a sale from someone else, whether that be, an agent that could potentially have collected a commission on a new sale, whether that be a homeowner or, a property owner that lost out on that sale. So or a wholesaler that lost out on, catching a fee on another sale. So that's why I said, this is a strategy that nobody talks about. But if you look at the nuts and bolts behind the strategy, from your personal finances, it makes total sense. So that's an example on business, buying down your debt. And you can look at it, anywhere across your business, whether it's buying down your debt on a on a property, whether it's buying down some other business debt. Maybe you have some credit lines, or a mortgage on a building that you own, that you operate your business off of. So take a look at your current financial obligations, take a look at your available cash, and maybe before you blow that available cash or buy something new, take a look at the ratios and see if it makes sense to buy down some of your business debt. So that's what I wanted to talk about from a business standpoint. Now, if you take those same principles of buying down your debt, eliminating your debt, and apply it to your personal finances, that is where it becomes a total game changer. Because with your personal finances, with your personal obligations, there's typically no income that supports that debt. The income that supports that debt is your income, the amount of money that you make every 2 weeks or every month or every year or whatever. You have to make enough money to support your debt and your obligations. So I talked about this again, I believe in a previous episode, is assets versus liabilities. So my personal goal is to increase assets and keep the liabilities down. And in my opinion, that's how you get ahead in life. That's how you create something, is to constantly work to grow those assets, but make sure that you're not, growing those liabilities that go along with it. So what I mean by that is a lot of people get caught up in, what's commonly referred to as the shiny object syndrome, or living their life on credit and payments and debt service. So I've seen many times where somebody starts a business or starts out at a certain level, and then they start their business. Their business starts to grow over the next several years or over the next decade. But you watch, and as their business is growing, they're buying more and more junk to go along with it. They're buying nicer cars. They're buying nicer houses. They're buying a vacation house. They're committing to additional debt. And if you look at it, if you stand back and look, it's like, okay, went from making $50,000 a year, $25,000 a year, to $100,000, $150,000, $250,000, $500,000, $1 million a year. The income keeps increasing. But if you look back, it's like, and you start to do some math, it's like, well, they went from driving a Toyota to driving a Range Rover, or 2 Range Rovers, and now they live in $1 million house, and now they got a vacation home, or a ski home, a home on the ski resorts or something like that. And it's like you see those monthly obligations that continue to go up and continue to rise, and it's kind of like getting caught up in the hamster wheel. It's like it never ends. The cycle never ends. So one of the biggest mistakes you can make, in my opinion, is committing your future income to serve your current lifestyle. And what that means is, getting caught up in debt, getting caught up in payments, getting caught up in shiny object syndromes. It's like, I had a good year, so I'm going to go buy a new house. Well, guess what? If you finance that house and you bought something that's out of your means, you're committed to pay for that house for the next, 15, 20, 30 years maybe. And because you had a good couple of years, that might not always, that growth and that income may not always be there, especially if you're a business owner. So increasing assets, reducing or eliminating liabilities is where it's at, by all means. So when it comes to buying down your debt, from your personal lifestyle, or eliminating debt, not having debt obligations. What I mean by that is, let's just take this for example. We talked about the house already. We talked about the rental property. Now let's just look at a car, for example. You're doing good. You had a good year. You want to go buy, a nice car. Let's say you're gonna, and of course, many people don't buy cars; they lease cars. Why? Because the payment's lower. And when you lease a car, the only people that win is the salesman and the dealers and the financial institutions that back those sales. If you look at the cost of a lease over time, it's absolutely ridiculous what those ratios and what that percentage rate equates to, what you're paying to actually have that car for a short period of time. So let's take that for example. Want to buy a new car. You did really well. You're doing great. You're going to buy a Range Rover. I don't know. What's a really nice Range Rover cost? $150,000, something like that, for the, one of the better ones, the wide body, the big body, whatever it's called. So it's a $150,000 Range Rover. Lease payment on that is $2,000 a month. And you're going to say, well, it's not $2,000 a month to lease a Range Rover. Well, it's pretty close. I mean, the lease payment might be, $1,300, $1,500, $1,800 a month, but then you got to put a big chunk down when you lease the Range. And then if you amortize that, or if you put that cost of your down over the monthly payments, it's probably close to $2,000 a month. It probably equals close to $2,000 a month. So your $150,000 Range Rover costs you $2,000 a month to have it for 3 years. So that cost of ownership is $24,000 a year on that Range Rover. Okay, so if you look at that, you got $24,000 a year that you're paying for that Range Rover. Now, everybody knows that you can buy a slightly used car that's still really nice for much, much cheaper, much less. You can buy that same $150,000 Range Rover that's, 3-4 years old for probably half price, call it $75,000. And again, if my numbers are off, my friends that are listening in the automotive industry, or my car friends, if my numbers are slightly off, don't give me a hard time. Just look at the ratios, just look at the concept, the message that I'm trying to get across. So you got your $150,000 Range Rover, $2,000 a month lease payment. It's like you got a brand new car. Well, after you drive it for 6 months, or after you drive it for a month or two, it's no longer a brand new car. It's a used car. So if you take that same Range Rover, you buy a used one that's 3-4 years old, $75,000. Okay. Now your option is lease a brand new Range Rover, cost you $2,000 a month. Or if you have the cash available, the money available, pay cash for a used Range Rover that's $75,000. Now, by paying $75,000 cash for that used vehicle, you've eliminated $2,000 a month in payments, $24,000 a year. Now, if you do the basic math, that's about a 30% ROI, because you've basically increased your income, or you've decreased your monthly obligations, which in a sense increases your income or decreases your need to make that much more money. You've eliminated $2,000 a month in payments, $24,000 a year. You paid $75,000 cash for the Range Rover. That's 30% return on investment. That's great. I mean, I look for 10%. So, instead of buying a brand new car, leasing a brand new car, I pay cash for a used car, or you pay cash for a used car, and eliminate the need for those $2,000 a month payments. 30% ROI. Now look at it. It's like, are you in a position? Are you in a point where do you really need that Range Rover? Like, what are you going to do with it? Maybe you're into cars. I mean, don't get me wrong. I love my cars. I love fast cars. I love performance vehicles. I love custom vehicles. But everybody's opinion, everybody's take on vehicles is totally different. So maybe you don't need that $75,000 Range Rover. Maybe you want to have it. Maybe you like it. Maybe you think it looks great, but you're like, you know what? I don't really need that $150,000 vehicle. And you know what? I don't really need that $75,000 vehicle. So do you have the ability to afford $2,000 a month in lease payment? Yeah, probably. A lot of people do. But rather than leasing that brand new vehicle, rather than buying that $75,000 Range Rover, maybe you buy an SUV or something that's a little bit still nice, but a little bit less expensive, a little bit cheaper, a little bit I don't want to say lower end model, because there's still some really nice vehicles that cost far less than Range Rovers. So you buy you buy whatever it is, the let's call it, let's get away from the luxury. Let's just say you buy a Jeep, or Jeep Wrangler, Jeep Grand Cherokee, or you buy a one of the Toyota SUVs or something like that costs you like $40,000-$50,000, maybe $30,000. Now, you wanted the Range Rover, you'd love to have the Range Rover, but you went with like the $50,000 Jeep or the $40,000 SUV or whatever the case may be. Now, you didn't commit to those $2,000 a month payments. Instead, you bought, you paid cash, $30,000, $40,000, $50,000. Look at that. I mean, just, you can do the math, you can do the ratios. You didn't commit to the $24,000 a year in payments. Instead, you paid, $50,000, and you got a vehicle that's still really nice, that gets you from point A to point B, does everything you need. And rather than committing to $24,000 a year in payments, you paid cash, $50,000 cash for a vehicle. I mean, that's like 50% ROI. And it comes down to choices, decisions. If you're truly concerned with your financial position in life and truly getting ahead, you should look at that. You should look at those ratios, and look at that true cost in everything that you do. Again, many people get caught up in the shiny object syndrome. Credits available. I know, daily I get emails. It's like, you have this available. You can qualify for this loan. You can qualify for that. Every store you walk into to buy something, it's like, do you want the credit card? Do you want this? Do you want that? It's like, no, I don't want it. Thank you, but no, I don't want it. I don't want those payments. I don't want those obligations. I don't need to buy that stuff, if I can't afford it. So, again, the idea or the commitment to yourself, in my opinion, should be get those assets up, get that income up, keep that income growing, but make sure that you don't have the obligations and the commitments, the debt service that goes along with it. Huge benefit is buying down your debt. When you make more money, you start to do good, you do really well, rather than going right out on a shopping spree and buying the big car, or buying the boat, buying the bigger house, on payments. Keep stacking it up. Keep serving and keep stacking. And when you have chunks of money, when you have available cash, look at what can I do to maintain my current lifestyle and pay things off and create a greater spread. Buying down your debt is huge. It's huge. Again, early on, I committed to, some mentorship, some training on a much higher level. Part of that training was, working the 7 steps of financial freedom. We're going to talk about that. I actually have a guest coming up on a future episode, who's a very good friend and mentor of mine. We're going to dive into those details, the 7 steps to financial freedom. But buying down your debt and paying down your debt is a huge part of that. And, I'm so thankful. I'm so grateful that, I've adopted those principles early on, and that I didn't get caught up in what we call the shiny object syndrome, where you're making more money, you're doing good, and then you go buy a bunch of dumb shit that you don't need. So, that's all I have for today. It's important to me, these messages that I share, it's the principles that I live by, the things that I follow, and I feel obligated to share that message and those principles and those thoughts with you. Take it for what it's worth. But, again, buying down your debt, look at those ratios before you go out and buy something that you really don't need. Can you take that income, or can you take that revenue, and can you create a greater spread? Assets up, liabilities down is where it's at, hands down. Have a great day.